Chapter 10, Part 2, Partial Year Depreciation. More often than not, you're going to be buying an asset not on the very first day of the year, but throughout the year. And so those assets that you purchase, during the course of the year, what this is saying is the first year there will be a partial for that fraction of the year you used it. And then on the last year, it will be the remaining partial. That's all that is saying, so don't be too confused by that. For instance, if you bought an asset at the end of March, that means you used it for 9 months that year, not the full 12. The first year you'll write off 12, and the last, maybe year 5, you'll only write off the remaining 3. Changes in estimates, again, depreciation, things can change. Your salvage value might change. Maybe its useful life, and management is allowed to adjust for this. They do have to disclose it on their financial statements, but there is some adjustment allowed for that. Again, you might change, like for instance, its useful life, its salvage value. Significant changes must be disclosed, but the reality is most companies do footnote any kind of changes. And the reason why sometimes is extending an asset's estimated life reduces depreciation. Management will sometimes abuse this. If they need to show a stronger balance sheet or less expenses, they might do this. And sometimes they're doing it not because there's a change in the equipment, because of their financial needs, which is abusive, but it does go on, and you should be aware of that. Again, how you report depreciation, you list your assets, you list its total cost, less the contra account, hence less accumulated depreciation, and then its net value, also known as its book value. So you will show all 3 components: its cost, accumulated depreciation, and its net. This slide just explains how things look visually. Obviously this is a straight line, this is a units of activity, and then a declining balance, whether that be the double declining or the Macer's method allowed by the government. Again, understand that companies can show one method for tax purposes and another method for financial statements, but they must state which one they are using on their financial statements. That's because analysts need to compare one company to another company in the same industry, and they might be using different depreciation schedules, and often do. So it allows them to adjust for that. I'm not going to spend a lot of time here. Again, they might use different methods for taxes versus their financial reporting. Additional expenditures. Understand that sometimes small items that companies will expense. What am I saying here? Let's say you're buying small tools, a saw, some hammers and so forth. Those smaller things, you're not going to show it on your balance sheet. You're just thinking expensive as you buy those things. And so this is more shown only on the income statement. Large items that are going to be used over a long period of time are going to be shown on the balance sheet, and hence it's known as a capital expenditure, because it's part of your capital of your financial statements, and then you're going to decrease that through depreciation. So understand there can be 2 different ways to approach this. And again, smaller items are just expensed usually. Repairs or improvements to your asset, you need to separate ordinary from extraordinary repairs. Take a car for an example. Tune-ups, maybe small repairs. These things you're just going to expense. However, large repairs, like let's say you do a complete new paint job or rebuild the engine completely, which is going to extend its life, at that point you need to add that cost to your cost on your balance sheet, and then extend the new depreciation schedules. So now this is called capitalization, because you're putting it on your balance sheet, whereas here you're just expensing it. Where's the distinction? It's management's discretion. There's no straight line here of deciding that. Disposals, yes, you can sell your equipment at any point in time, and when you do, you have to remove your accumulated depreciation from your balance sheet, as well as removing the cost. And then you do have to record if there's any gain or loss from that sale. If you sell it above your book value, you will have a gain, or if you sell it for less, it will be a loss. costs, and that's all that's saying. And here they're showing you they're removing the equipment. Here they sold it maybe for its book value, and maybe show you bring the depreciation expense and the accumulated depreciation up to speed, and now you're disposing the equipment on July 1. So maybe you're not going to do this depreciation at the end of the year because it's partial year, and you're selling it now, so you need to record that now. And then you notice that you have a new T account, either loss or gain on disposal of equipment. That's all this is showing. Natural resources. Again, these example would be like oil mines, coal mines, gold mines, oil fields. It could be ranches, could be timber. There's a lot of major assets that are considered natural resources. And when you use up a natural resource, you are not depreciating it. What you're doing is you're depleting that resource. Now, depletion and depreciation act very similar from an accounting standpoint, but the words are separated and are distinctive to the type of asset. And I am going to test that, so you need to be aware of that. And again, but the methods from an accounting perspective is the same. You take its cost minus its salvage value over some units that you're going to be depleting, and you get, so it's the same method, although we use a different word for depletion versus depreciation. And again, you'll have also an accumulated depletion as you extract that asset from the ground. Whereas plant assets are depreciated, and they're separated from its natural resources. Intangible assets is an important concept. Intangible assets are not physical, hence intangible. They're without physical, but what they are is usually a legal right or a privilege. And these can be like, an example of them would be like patents, copyrights, leasehold, and trademarks, and so forth. And you record these again the same way as you did other major assets. It's various components for acquisition, legal fees, filing fees, and its purchase price as an example. But here, you're going to amortize it. Key word is amortization. So you record it. So an intangible asset, you amortize is the same concept as depletion or depreciation. So there's three concepts of these three words. I'm going to mix them up, so you do need to know that. Intangible assets are recorded at cost. It's just like a depreciation again. You allocate its cost, hence you amortize it over its useful life. So be careful of these words. I'm going to mix them up on you. An example, patents might be for 20 years, whereas copyrights might be for 75 years. I'm not going to test you on research and development. I think that's too complex at this stage. It's also very, very complex from the FASB. But research are usually, and development costs are usually expensed on the income statement. They're not capitalized, although many companies try to capitalize this, and I'm not going to get into that for the test here. Again, copyrights might go for 70 years after the life of the creator. So different kind of schedules for amortization depending on the asset. An example of some are trademarks, trade names. Goodwill. Goodwill is when one business buys another business and they paid a price over and above its book value. Maybe the company showed a value of $1 million, but the company on a market value was bought for $2 million. Well, then they're going to show this company on their assets as $1 million, and then there'll be an intangible for goodwill for the other $1 million. Franchises, an example, Taco Bell's, the McDonald's, people have to buy those legal rights, and so those are known as franchises or licenses. Asset turnover, here's a key term. Net sales over average total assets. Be careful when you see average. You got to take some beginning period, some ending period, and then divide by 2. Take a beginning plus ending, divide by 2. It could be your beginning for that period and the end of that period. And it just says how well companies may be using its assets compared to its sales. And so this is one measure that analysts use to evaluate different industries and so forth. That's all for this chapter. I went a little fast. I just want to exclude the research and development costs, and do get used to the words amortization, depletion, and depreciation, and the different methods of the like the declining method versus straight line. That will be the component of the test. I am not going to test the research and development. That will be all for this chapter, and we'll start chapter 11 on another video. Thank you.